from ADK Wealth Advisory Group, headquartered in St. Louis. My name is Dan Davis, president and co-founder. I want to thank you for your time today. Purpose really is to look backward over Q2 and then look forward for upcoming Q3. So for quarter two, I think some of the real main headlines were Brexit. And you could really sum up Brexit by saying it was created a two-day real uncertainty and quite a bit of volatility in the financial markets. But in the end, it really appeared to be nothing major for the financial markets. Now, it's my opinion that because on August 4th, my father's 77th birthday, the Bank of England stepped in with some serious quantitative easing and dropping interest rates and some other bank technical monetary moves that were way far exceeding what the markets had expected, and you saw a lot of assurance that the central bank would do what needs to be done. But the unwinding of Great Britain and the UK from Europe is not a simple vote. It's a matter of years. So we think there's more to come on that particular subject. But the other issue that I would say was a major headline was just in general was the equity markets. I would say that the first quarter of the year, all of us know that the first 6 weeks started off really rough. The second quarter was a retrenching, making up of what had been lost in the first quarter. And even in spite of the Brexit, in spite of earnings reports coming out from Fortune 500, namely S&P 500, a little bit lower than previously dropped forecasts. So in simple English, earnings weren't all that great, but they weren't bad enough to cause the markets any major discourse. I think the real reason for that is that you have so much tailwind coming from global central banks' policies, like what you saw in the UK, like what you're seeing from the ECB, like what you're seeing in the Bank of Japan. You could say that we're awash in liquidity globally, and that's having a big stimulus on the equity markets more so than the economies of the areas that are being stimulated. The other major tailwind came from U.S. consumers. It appears as though the big shock that happened with unemployment in 2008 and 2009, that many of those jobs, while not replaced with the same level of income, those people that want to work are back to work and they're out spending money like good Americans. So the headwinds that we're seeing are things around the election, a lot of uncertainty, probably the weirdest election that anyone watching this has experienced in their lifetime, certainly the weirdest I've experienced in mine. The other would be the dollar and oil, and those have been constant points that companies globally have used as references. It seemed to me to be a bit of an excuse at this stage. I think it's just that we're fairly late in a market cycle and you start to see earnings declining as a result of that. On the fixed income side, when you really take a look at interest rates, that's probably another area that's a big surprise. As you know, Fed Chairperson Yellen and her cohorts raised rates in the fourth quarter 2015, and they said they would raise rates probably 4 times, but gradually in 2016. Well, we're sitting here at the end of the second quarter, beginning of the third quarter, and they still haven't raised rates. Why is that? There's really a couple reasons. One is if you take a look at global interest rates, just take a look at Japan, for example. Japan, when they issue a new 10-year bond, they issue it at negative yield. If you take a look at the German Bundes 10-year, same thing. When they issue it at negative yield. The U.S. 10-year treasuries call it about 1.5%, vacillating in that general vicinity. So the key question there is, how can Germany and Japan offer a bond that anyone in their right mind would buy if they're guaranteed to lose money? And it gets down to governance and politics. So what do I mean by that? If you are a German pension fund or a German insurance company, you have to buy a certain amount of U.S. government debt. So the net effect of it is that when when the Germans issue their bond, they know that they have a group that's going to have to buy it by law. Same in Japan. Not sustainable for long periods of time, but it's having a heck of an effect on lowering interest rates. And so if Fed person Yellen goes out and raises rates at this particular point, the problem there is that all of a sudden you get the dollar appreciating. There's two main functions that the Fed has. One is employment, and two is inflation. So if the dollar raises by quite a bit and strengthens, it really hurts our ability to export. That inability to export or get hurt on your exports hurts employment. So you take a look at a bunch of things, and the long and short of it is the Fed has not raised rates year to date. If you take a look at LPL's research, we believe that there's about a 25% chance that they'll raise rates in their September meeting. And we believe that that by the end of the year is probably about a 75% chance that they will have raised rates. The net effect of it is that the U.S. economy is there able to withstand a gradual increase, but the global forces don't really predicate it. So moving on from second quarter and thinking about third quarter, if you take a look at what our market expectations are, if you think of four potential scenarios, the first scenario is what we think is the most likely, in that the markets, think about the S&P 500, would have a pullback during this pre-election period, presenting us a buying opportunity on the other end of that. You and I both know that investing involves risks. That's a very well-researched guess, but it's of the four scenarios, it's the one that I believe most likely. Second would resemble what happened early summer 2015, where the markets just kind of go sideways, where there's not much volatility and it doesn't really do much up or down. Between the two of those scenarios, I would venture to say I think that's probably about 75% likelihood. Another scenario is that the markets continue on an upward trend. While I think it's unlikely, it is possible. And then the last would be that we had some kind of a market collapse, like a 2000 or 2008. Again, I think it's fairly unlikely. As a footnote, I do think there's a high probability that that could happen in the next 3 to 7 years, but that's far enough out where it's out of the context of quarter two and quarter three. If you take a look at interest rates, as I mentioned earlier, LPL believes that we'll see an interest rate increase by about 0.25% sometime either September or after the election. There's a lot of weirdness around that. I mentioned already the global pressure. I mentioned that the U.S. economy is ready for it. But the election does pose a wild card in that. What we really can't tell is Yellen going to wait till after the election for political reasons? Or does she want to take a stance to make herself look a little bit more firm than what she's been made out to look like? We do know she's a dove, but she looks very, very dovish, almost like a flock of doves at this particular stage. Wouldn't want that job. I think it's a very difficult role for anyone, and I do think that Bernanke and Yellen have done a very good job. So interest rates, long and short of it is, we believe that you'll see a 0.25 point increase by the end of the year. Some major risks that we're looking at are around China. China has not fixed the problems that really popped up last year. And when they popped up, it wasn't new news. China's way overbuilt. They've got a lot of excess debt, and they've got to recapitalize their banks in order to be able to fulfill those loans. In a shame-based culture like China is, I am not confident in any time in the near future that they're going to do that, because it first admits that we've done something that hasn't worked out. The second is around Italian banks. That's catching a lot of headlines. The ECB did a shock test of the European banks, which came out pretty solid. There were several banks, most of which were on the Italian side, that really show a lot of concern. So there's some risk with Italian banks. And then the last that you haven't really seen much headline news on is Russian reserves. The sanctions that have been imposed, Russia's really in a financial bind. It's hard to say, will they run out of money, will they not? New York Times had an article about a year ago saying sometime in 2016, late to mid-2017, if the sanctions hadn't been lifted, that they'd run out of reserves. Russia's Iron Curtain, you really don't see much news on that, but I think that we'll see something flare up on that. So in summary, we think that you'll see some increased volatility between now and the election. I think interest rates will go up by the end of the year, and we think that there's some risks out there that have us with special attention. We do believe that you'll see positive returns from the portfolios. Maybe not what they are year to date. Year to date, the returns are up quite a bit more than I would have expected, but I'll always take that. And again, just for legal disclaimers, you and I both know from having invested, you just never really know what markets are going to do in the short term, but we're fairly optimistic. On that note, I'd like to say thank you very much for your trust that you place in my team to help you achieve and pursue your life dreams and financial goals. It's truly an honor for us to be able to do that for you. The last 28 years of serving you and your family have been, candidly, a lot of fun for me. And as I look across the camera and see my son filming on the other side of this, thank you for your help in business, because it's allowed me to take care of my family, and he's most recently graduated from college. So good job, Blake. On that, I will bid you farewell and invite you to like us on Facebook and connect with us on LinkedIn if you haven't already done that. And again, please feel free to share this with any friends or family that you think should be clients of ADK and Dan Davis. Thank you for your time. Bye-bye.